Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Integrating risk management with valuation techniques. Integrating risk management with valuation techniques is essential for corporate finance professionals striving to enhance company value. Effective risk management identifies, assesses, and mitigates potential threats to a firm's financial health, while valuation techniques determine the worth of an asset or a company. Combining these elements allows for more accurate and robust financial decision-making, fostering sustainable growth and value creation. The integration of risk management into valuation techniques begins with understanding the fundamental concept of risk. Risk, in a financial context, refers to the uncertainty regarding future returns and the possibility of financial loss. It includes market risk, credit risk, operational risk, and liquidity risk, among others. These risks can significantly impact a firm's valuation by influencing its cash flows, discount rates, and ultimately its overall worth. For instance, market risk, driven by fluctuations in asset prices, interest rates, and currency exchange rates, can alter the expected returns on investments, thereby affecting a firm's valuation. One of the primary valuation techniques in corporate finance is the discounted cash flow method, which estimates the value of an investment based on its expected future cash flows, discounted back to their present value. Integrating risk management into the DCF approach involves adjusting the discount rate to reflect the risk associated with the cash flows. The discount rate, often represented by the weighted average cost of capital, must account for both the cost of equity and the cost of debt, incorporating the risk premiums for each component. For example, a higher equity risk premium would be applied if the firm operates in a highly volatile industry, leading to a higher discount rate and a lower present value of future cash flows. This adjustment ensures that the valuation accurately reflects the firm's risk profile. Another critical valuation technique is the use of multiples, such as the price-to-earnings ratio or the enterprise value-to-EBITDA ratio. These multiples provide a relative valuation by comparing the firm's metrics to those of similar companies. Risk management plays a crucial role in this technique by identifying the appropriate peer group and adjusting the multiples for differing risk levels. For instance, a firm with higher operational risk might warrant a lower P/E ratio compared to its peers, reflecting the increased uncertainty in its earnings stability. By incorporating risk considerations into multiple-based valuations, corporate finance professionals can derive more accurate and reliable estimates of a firm's worth. Real options analysis is another valuation technique that benefits from the integration of risk management. Real options provide the flexibility to make strategic decisions, such as expanding, delaying, or abandoning a project based on evolving market conditions. These options are particularly valuable in high-risk environments where uncertainty is prevalent. By applying risk management principles, firms can better assess the value of real options and make informed strategic choices. For example, a pharmaceutical company facing regulatory uncertainties might use real options analysis to evaluate the potential benefits of delaying a drug launch until more information is available. This approach allows the firm to mitigate risk and capitalize on favorable developments, ultimately enhancing its valuation. Stress testing and scenario analysis are also integral to integrating risk management with valuation techniques. These methods involve simulating various adverse scenarios to assess their impact on a firm's financial performance and valuation. Stress testing examines the effects of extreme but plausible events, such as economic recessions or market crashes, on the firm's cash flows, discount rates, and overall value. Scenario analysis, on the other hand, explores a range of possible outcomes based on different assumptions about key variables, such as sales growth, interest rates, or commodity prices. By incorporating these techniques, Firms can identify potential vulnerabilities and develop strategies to mitigate their impact, thereby enhancing the robustness of their valuations. A practical example of integrating risk management with valuation techniques can be seen in the oil and gas industry. Due to the sector's inherent volatility and exposure to geopolitical risks, companies must carefully assess the impact of these factors on their valuations. For instance, an oil company might use scenario analysis to evaluate the effects of fluctuating oil prices on its cash flows and overall value. By incorporating risk management principles, the company can develop strategies to hedge against price volatility, such as entering into futures contracts or diversifying its energy portfolio. These measures not only help mitigate risk, but also provide a more accurate and stable valuation of the company's assets. Integrating risk management with valuation techniques also extends to mergers and acquisitions. In M&A transactions, accurately valuing the target company is crucial for negotiating a fair price and ensuring the success of the deal. Risk management plays a vital role in this process by identifying and assessing the risks associated with the target company, such as financial health, legal liabilities, and market position. For example, a due diligence process might reveal that the target company operates in a highly competitive market with declining profit margins. By factoring in these risks, the acquiring firm can adjust its valuation accordingly, potentially negotiating a lower purchase price or including contingency clauses to mitigate identified risks. Furthermore, integrating risk management with valuation techniques is essential for capital budgeting decisions. Capital budgeting involves evaluating potential investment projects to determine their feasibility and alignment with the firm's strategic goals. By incorporating risk management, firms can assess the potential risks and uncertainties associated with each project, such as technological changes, regulatory shifts, or competitive dynamics. For instance, a technology company considering investing in a new product line might use real options analysis to evaluate the potential risks and rewards. By understanding the value of flexibility and the ability to adapt to changing market conditions, the company can make more informed investment decisions, ultimately enhancing its valuation. Moreover, integrating risk management with valuation techniques helps firms optimize their capital structure. A firm's capital structure, comprising debt and equity, significantly influences its cost of capital and overall valuation. Risk management principles can guide firms in determining the optimal mix of debt and equity to balance risk and return. For example, a firm with stable cash flows and low business risk might choose to increase its leverage to benefit from the tax shield provided by debt. Conversely, a firm with volatile cash flows and high business risk might opt for a more conservative capital structure to avoid financial distress. By incorporating risk considerations into capital structure decisions, firms can enhance their valuation and achieve a more sustainable financial position. In conclusion, integrating risk management with valuation techniques is a critical component of corporate finance, enabling firms to make more informed and accurate financial decisions. By understanding and mitigating risks, adjusting discount rates, using appropriate multiples, valuing real options, conducting stress testing and scenario analysis, and optimizing capital structure, firms can enhance their valuations and create sustainable value. This comprehensive approach not only improves the accuracy of financial assessments, but also strengthens the firm's ability to navigate uncertainties and achieve long-term success. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UExcel, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.